Buying real estate notes can potentially yield much higher returns for you, coupled with far lower risk than many other investment vehicles available today. Seller-financed real estate notes are, in a great many cases, bought at a discount off face value, thereby creating a rate of return considerably higher than the original instrument. That is, unless you happen to be creating a new note, in which case you write the original terms of the note yourself. Also, the note purchase can be structured in such a way that as your return increases, the risk decreases, so unlike traditional market investments. So in a seller finance note transaction, the buyer of the property makes monthly payments on the note according to the terms which are spelled out on the note. Typically, the transaction involves a note and a mortgage, which are two separate instruments. The party receiving the monthly payments on the note may, at some point along the line, elect to sell their right to receive the remaining monthly payments to another investor in order to raise cash. So let's better illustrate the concept of how a note may be bought at a discount. Okay, so let's say you own a home yourself that you bought through a conventional financing on which you're making regular monthly payments. At some point, your bank may, in certain cases, sell your loan off to another party, like a hedge fund or a private equity firm, without your being aware of it, because your monthly payments are always going to the same place. For example, maybe a servicing company address. That other party likely paid less than the outstanding balance, what you owed at that point in time, in order to acquire the rights to collect the future monthly payments on the mortgage and note. So we call that buying at a discount to increase the investor's return. He likely paid less than face value to the seller of the note. The reason notes are bought at a discount is all due to the time value of money. Okay, cash in hand today is being worth more than having to wait months and years before collecting it. And because the note investor paid less than face value, he is getting a greater return than the interest rate you are paying because your payment amount on the note remains the same as it was originally. Privately held seller-financed real estate notes can be and are bought and sold in this manner on a regular basis. A note holder who is collecting monthly payments may at some point decide to cash out of his position by going out and finding a willing buyer for that note who does his homework and decides that the loan is a good investment. After performing proper due diligence, the note buyer arrives at a figure by determining his desired yield and then offers to purchase the note for something less than face value. He's putting up cash today, but will get his money back, earning a higher rate of interest than the original terms of the note. They'll get his money back over a period of months and years. So because he has to wait to recoup his money, he pays less than the outstanding balance. Remember now, you're buying the note, not the property. So an important distinguishing feature of a note purchase as opposed to real property is that you're only buying the note and not the underlying property, which secures the note. The payer continues to make monthly payments as agreed. The only thing that changes for the payer is that he is now sending the monthly payments to a different address. In this case, it would be yours. If the payer defaults at some point along the line, you, as the note holder, have the rights to foreclose and take possession of the property. So you get all the security of real estate behind your investment, but without the attendant hassles associated with landlording, like tenants and toilets. For reasons such as I just cited or outlined, many real estate investors are now buying notes instead of property upon discovering that discounted notes are safer, easier, and more profitable for them than brick and mortar real estate investing, while devoid of all the inherent headaches. What's more, real estate notes are often bought without the note investor physically visiting the underlying property. The security for the note, which is the property itself, can oftentimes be reviewed by conducting due diligence through websites that offer a broker price opinions, along with a wealth of other information, including tax and buyer history and things like that. Notes are not limited to real estate. You can buy notes secured by a whole myriad of things, almost unlimited possibilities or scenarios, including for example, golf course paper, car paper, and business notes, which are plentiful actually and can be found rather easily through networking with business brokers, for example. So let's define a mortgage note. Okay, a mortgage note is actually a note secured by a mortgage loan. The note spells out the terms such as interest rate, payment amount, and other such stipulations. Okay, if you own a home and you bought that home by taking out a mortgage loan from a conventional lender, there is a note attached to it which spells out the specific terms. Okay, a note is a promise to pay and is essentially an IOU. Notes can be secured by a private mortgage as well as conventional. A privately held mortgage note is held by a private party as opposed to a conventional financial institution. Privately held mortgage notes can be bought and sold exactly like real estate. And in much the same way conventional loans are bought and sold by banks to private equity firms or hedge funds or to entities such as Freddie Mac. The same practice goes on in the private sector, only on a smaller scale involving private money. So it is important to know that there are some regulatory considerations you may need to be aware of depending on your particular approach to doing business. And you may want to check out these things. For example, do some research at our website, noteinvestors.com. We have more information on the types of things you should be considering or for a more in-depth discussion and analysis. In certain cases, you may find it advantageous to have an outside firm service your transactions, especially if you're doing this on a larger scale, so as to ensure that you always remain in compliance. Okay, and it's very smart to broker a few notes to the large investors, right? Watch what they do and become thoroughly familiar with the due diligence process before you start buying notes for your own account with your own money. All right, so that's it for today. I've outlined Notes 101, so to speak, as far as some of the things you should, or many of the things you should know about. As a general information on notes. So don't forget to visit our website at noteinvestors.com. We have a ton more information on the subject of note investing. Also be sure to subscribe to this video channel. We're going to be producing a ton more videos educationally in nature regarding note investing over the next several weeks and months. So be sure to subscribe. See you on the other side.